And now, please welcome our moderator.
Hello, everybody. Rick Newman here with Yahoo Finance. We're here to talk about retirement security. It was a problem before the COVID pandemic, and it's a worse problem after the COVID pandemic. Joining us to talk about this is Roger Ferguson, who is president and CEO of investing firm TIAA, and Penny Pennington, managing partner with Edward Jones. Good to see both of you. Before we get into discussion here, a couple of notes about the panel. First of all, we are going to take audience questions toward the end. The way you submit those questions, there should be a box on the right of your screen where you can ask the question. I'll remind people that they can ask questions later on in the panel. And we're also going to try to conduct a couple of poll questions. We're going to start with one right now. So the way you do this is, so I'm going to ask the moderator to launch the poll. It's going to take a few seconds before it comes up on your screen. But you can participate in this poll by using the panel on the right-hand side of the screen. I'm hoping this all works. Click on the tab that says poll, it says polls, and then answer the poll question. So here is the first poll question. We're asking you for a one-word answer because this is a word cloud format. So here's the question. Based on your experiences during the COVID-19 crisis, what do you think is the greatest new threat to retirement security for pre-retirees and retirees? So just answer with one word if you can. If you have to use two words, okay, fine. But this is a word cloud, so just try to do it in one word. So now let me get to the topic at hand. Roger Ferguson, I'm gonna start with you. Why don't you characterize where we were before the COVID crisis in terms of retirement security and all the people, especially people 50 and older, who are just not prepared for retirement?
Well, you've characterized it exactly correctly, which is that retirement was a challenge before the crisis. Some people refer to it as a retirement crisis. I prefer to think of it as a challenge. And it was a challenge around three areas that I'm sure we'll talk about. One was, frankly, not enough people were covered by retirement plans at work. And secondly, people were not saving enough. My friends and former colleagues at the Fed and others, I've seen estimates from $4 to $7 trillion of shortfall in retirement savings. And then the third was most retirement plans, the 401ks type, didn't really have an option for an in-plan guaranteed income for retirement life. And so there are a number of failures. And in addition to those, in the private sector, obviously, a great deal of discussion even before the crisis around the challenges in Social Security. So we started at a fairly precarious place in terms of retirement security for most Americans.
So we've now got 11 million fewer people employed than we did before the crisis. Obviously, some of those people have lost benefits, including retirement benefits. Incomes are under stress. People are tapping their retirement accounts in some cases to get by. Roger, how bad has the crisis or the challenge, as you put it, gotten on account of the COVID pandemic?
Well, my company just released a survey. We surveyed about 3,000 middle-income Americans making over $40,000. And not surprisingly, we found an increase in financial stress and retirement stress. So first, to the point that you made, about 60% of them said that there had been some impact in their financial lives. And that impact had been severe in some cases. So roughly 1/3 said, to your point, that they had lost a job or had some other impact in their employment security. Roughly 20% of them had to dig into their nest eggs, their rainy day funds. And about a quarter of the folks that we surveyed, and this was, we think, a representative survey, had to take on more debt. When it came to retirement security, very interesting findings. First, of those who are still working, 9 out of 10 said that achieving retirement security was a high priority, above paying down debt and above a number of other things. So even in this crisis, the issue of retirement still is front and center to many people. Unfortunately, in that space, 60% of them said that they were not on track. And out of that group, roughly a third, about 30%, said, in fact, that the crisis had put them even further behind their plan. So obviously, this has been a crisis that's hit financial stability for the middle class in general, and in particular when it comes to something that's very important to them, which is achieving retirement security.
Penny, how stressed out are your clients?
Well, I'll focus on our clients, 7 million clients across North America, and then maybe add a little to what Roger shared about the investing public, the retiring public in general. So we have 7 million clients in the United States and Canada. It's our job to be their financial advisor and coach. And so in good times and especially in bad times, during periods of market volatility, during periods of stress that is more localized to a family or a particular family situation, it's our job to help reduce anxiety, to provide perspective, to help clients from making emotional decisions. And it's easy to make emotional decisions when stresses in life are occurring and when markets are volatile. But we know, all the research tells us, that keeping emotions out of the investment decision is the right thing. But there's something else having to do with being a good financial advisor, is to be a good coach, is to help people understand what's most important to them and their family, and then do the hard work of setting those goals, setting a path toward those goals, and recognizing that there are trade-offs between and among those goals. So there's a very real trade-off that families make every day about, do I put that money in my retirement plan or do I put it in my college savings plan? And what we're seeing right now with our clients and across the public is those trade-offs have become quite acute. And in fact, they've intersected mortality. They've intersected generationally with parents who are helping their adult children who've lost their jobs with their to pay their bills. So just adding on to what Roger was sharing, we have recently done a survey as well. And what we found was 20 million Americans have stopped contributing to their retirement plans. 3 in 10 say that they are going to have to work longer now, even if they were saving for retirement. And getting to this point about the multi-generational effect of the environment that we're in right now, 71% of those that we surveyed said that they would help their adult children based on a COVID-19 effect with a job or what have you, even to the detriment of their own retirement plan. And so this multi-generational effect is really adding to the challenge that we already had. We know from working with our own clients that they are less emotional in the environment that we're in, because we've coached them for years to seek to take the emotion out of these decisions, and that they're more confident, on average 10 points more confident than the investing public. And that is because they're being advised. And so I know that this is going to be a theme through our conversation today. On average, clients who are advised have 25% more assets than those who don't. And so we're going to be talking a lot, I'm sure, about the power of advice, of perspective, of education around planning for one's retirement.
Penny, I feel like part of the bargain, if you're an adult, my adult kids are only in their young 20s, but I feel like part of the bargain, if you help your kids out, you hope they're going to help you out later on and kind of pay you back. I'm not sure it works out that way, though. But this is a very rational way to manage your money. I mean, if you're running short of money, you have to pay today's bills before you pay tomorrow's bills. So in that sense, it's rational, isn't it, for people to reduce contributions to retirement or even tap retirement if they're having trouble paying the bills today?
Yes, that is an option. And in fact, there was a COVID-19 relief option afforded that people could take money tax-free from certain types of retirement plans. So we recognize that that is a bucket of money out there that can be tapped. We've just all got to recognize what the ramifications of tapping that are and recognize what today's bills mean. Now, I want to be very thoughtful throughout this entire conversation in that both Roger and I may be talking a lot about folks who've got enough means to be able to have that conversation rationally about which bill to pay. We know that there are millions of Americans out there who are having really challenging conversations about the basics of life and enough money to do those things. In terms of which bills to pay, there are a number of bills that we're not having to pay right now. In fact, the savings rate went way up as a result of the payments that were made to Americans in the past number of months. The savings rate went way up because we weren't in a position to spend as much money on certain kinds of things that we had spent money on before. And so those decisions about which bills to pay and what buckets of money to access are very real ones. My point is that making those decisions as non-emotionally as possible, and making those decisions with the near, medium, and longer term effects in mind are really important. And often that comes as a result, being able to do that comes as a result of getting some advice and having an outside perspective help you do that.
Roger, are you dealing with that? Are you advising people how to make these tough decisions between whether they should reduce retirement contributions or tap into that? I'm sure you are.
We're seeing some of the same things. Let me echo some of the wise things that Penny had to say. First, certainly, this is not a set of issues that one has to go alone on. So seeking good advice is relevant. And for some people, that may be advice in person. Others may be online. There may be actually, for those who don't have much in the way of resources, free advice tools. And so we shouldn't think of advice as something that's only available to the super rich. Middle income and lower income folks can perhaps use some of the free tools that are available. With respect to tapping into retirement, we've seen actually a number of things. First, even in some cases where maybe the employer has stopped the match, for those who still have jobs, we have seen, in fact, that people have still their own contributions at a higher rate than maybe might have been expected. And so we should be careful not to sort of stereotype that the first thing that stops is the retirement contributions. I think this goes to another point that Penny made or implied, which is one really needs to have a long-term plan and recognize, as she said, the short, intermediate, and long-term goals. And when the short term throws you off of your long-term plan, developing an approach to get back onto that plan. So the risk in what we call leakage, which is taking money out, withdrawing money from a retirement is actually pretty high. First, depending on when you do it, there could be penalties. So one has to be mindful that it's not a free bucket of money. There may be penalties if you remove too soon. And then the other problem is, of course, getting back in. What we've seen is if people change their behaviors and get out of the behavioral pattern of saving for retirement, there's an inertia that may slow them down from getting back in. And so, yes, these are tough trade-offs, but recognize, as Penny implied, and I've said as well, there are risks to avoiding or getting off of your long-term plan. So making sure you have a theory, hypothesis, an effort to get back on if you are temporarily blown off course. And advice can be an important part of that.
Okay, I think we have some responses to that first poll. If we can see what those are. I haven't seen these, and I'll be amazed if this works. Just going to remind everybody, okay, that we see them. Okay, so this was the question. Based on your experience during the COVID crisis, what do you think is the greatest new threat to retirement security for pre-retirees and retirees? So lack is the largest word there, lack of something, I guess, lack of savings, lack of money, small business, unemployment, sustainability. I see the word Republicans, but I don't see the word Democrats. I see the word Trump, but I do not see the word Biden. Penny and Roger, anything jump out at you from this?
Well, what jumps out at me is exactly what you've pointed to, which is the word lack, like just a general sense of insufficiency. The other that jumps out at me is when you didn't talk about, which is uncertainty. And I think that is really one of the major issues here. We are going through a period that has had a historic number of challenges. First, a health challenge, an economic challenge, a social justice challenge. Potentially, we'll see how the politics play out, but that creates some uncertainty. And so, one of the things we know about human beings is during periods of uncertainty, people tend to freeze, which may be the right thing to do if it keeps you from acting in an irrational, emotional way. But people certainly do not enjoy uncertainty. So in addition to the ones that you've talked about, lack jumps out at me, and certainly uncertainty jumps out as another one of those themes. And we should also look at, I think it's long term. We should come back and talk about the issue of short versus long term, because as we started off, the retirement crisis has been sort of a long-term challenge and has become a short-term crisis for many people. So the long-term element also jumps out at me when I look at these words.
Well, let me ask both of you, before we go to long-term, let me ask you about the short-term. There have been considerable differences, if I understand correctly, in retirement planning and retirement security, broken down by race and broken down by gender, and probably broken down by some other demographic factors. I mean, I know from my coverage of the economy, President Trump, for example, likes to say the black unemployment rate got to record lows under him, but it's also true that the black unemployment rate has gone up by a lot more than the white unemployment rate during COVID. And that probably has knock-on effects to all the things we're talking about. If you lose your job, you lose your benefits and so on. So what do we know about race, gender differences, other types of differences in terms of retirement planning before COVID and now? Whoever wants to jump on that.
Well, I'll start with a little bit, and then Penny, you should please jump in. So the first thing that we do know is, even before you get to questions of retirement security, there's a dramatic difference in financial literacy between the minority communities, Black and Hispanic, and the white community. And we do know that an absence of financial literacy is correlated with a number of other, bad financial outcomes. So folks with a lower degree of financial literacy do tend to save less for retirement. They too do tend to use debt more. They tend to get into deeper trouble when it comes to debt. And they tend to have, by definition, smaller nest eggs that are less well diversified. So we should start with, that question of financial literacy. Then you put your finger on another question, which is, in good times and bad times, the unemployment rate for African Americans has tended to be several percentage points higher than for the rest of society overall. And that plays into the kinds of points that you've made in terms of financial well-being and security and jobs, et cetera. And so, the issues that we're confronting when they are seen through a race lens are quite different. And the final thing this crisis has pointed out is, health outcomes for the African American and Hispanic communities, are much tend to be more severe than for the white community. And so you get a compounding of effects that are perhaps putting the African American community and Hispanic community even further behind the overall society, across a range of these issues.
Penny?
Yeah, I'll carry on from there, talking about the wealth gap between Black and white. I was talking with one of our Black financial advisors a couple of months ago, and he said, "Penny, what you got to recognize is that in the white community and white savers, some people have a head start on retirement because wealth is being passed from one generation to another. And that affords all kinds of options and different ways of thinking about those buckets of money, for example, because of an understanding of this wealth transition. And in fact, it's a huge topic in the financial services industry, is the transition of wealth, the trillions of dollars of wealth that will be transitioned from one generation to another. This isn't happening in the Black community as much as it does in the white community. And so, as this Black financial advisor was saying to me, he doesn't have all Black clients, but when I talk to my Black clients, they've got a different set of options than traditionally my white clients have. So that really brought home to me in a very specific and personal way that wealth gap between the races. I'll go. Yeah, please,
Go ahead,
Roger,
Penny.
go ahead.
No, just to
No, go
give you
ahead.
some statistics on Penny's really good point. I think in a macro sense, it is said that whites tend to have 10 times the wealth of the Black community. And so that point about wealth is very, very important. The other thing that we know is so much of wealth is built up in houses for middle income for individuals, so their home ownership levels are really quite different. And so I think Penny's point is well taken, and just a couple of statistics that sort of validate the point that she's making about the wealth gap as well as the income gap. I'm sorry, Penny, please continue with your thought.
No, not at all. I'll go to the gender piece. There's been so much research and so much written about wealth building among women versus men. Some of the same effects apply in that any wage disparity is going to show up in women's ability to save. Disparities of who goes home to take care of children or parents affects women and their ability to save. And there's a tremendous amount being written right now about both of those things as it affects women and their retirement security. The jobs that are being lost, many of those are jobs that women have historically occupied, and the necessity of families whose children are coming home to learn from home, or parents that are needing to be cared for during this health crisis. Sometimes that falls more heavily to women. And so there is going to be an after effect that is gender related as it relates to women and their saving. What we've known historically about women investors is that they're quite planful. They do take into account a number of different trade-offs in their lives, caring for others, the longevity of their working lives, what they want to spend in retirement, and how they learn and think about the perspective that needs to be gained about the markets and simply how to invest and save. So women are very planful about that. And there has been research that's done over the years that has shown that they're actually better investors because of that long-term orientation, that sense of planfulness.
Penny, I might be stealing that word planful from you. That's a good one. We got through that first poll without crashing the system. So let's see if we can queue up this second poll. As a reminder, it's going to take a few minutes seconds rather, not minutes for you to see this poll on your screen. But the way to participate in this is use the panel on the right-hand side of the screen where there should be a tab that says polls. So try to click on that to answer question number 2. Here's question number 2. This is a multiple choice. Which policy shift would be the most critical to narrowing the retirement gap? And I've got a visual aid here. Great, that's great. And you can see your choices are number 1, bolster and enhance Social Security. And it's actually not number 2, it's number B, create incentives to increase individual retirement account contributions. C, allow states to provide retirement savings plans to residents. Or D, support employers that introduce and maintain defined contribution plans. So again, the question is, of those 4 choices, which policy shift would be the most critical to narrowing the retirement gap? And that's actually a great question for the panelists. We're talking about all these problems. In a way, they sound overwhelming, how unprepared a large part of the U.S. population is for retirement. We did get some help for people in the I think it was 3 or 4 stimulus plans that Congress passed. Some of that was just cash in your pocket, those $1,200 checks a lot of people got. Some of it was that supplemental unemployment insurance. But that is running out for most people. So what do each of you think is sort of the best thing, if it's a policy decision, Congress could do now just to help people from a retirement perspective? Is just helping them pay their bills so they don't have to tap into retirement savings?
Well, that runs short and low at a point, and in fact, that's the daily conversation. That's gonna that will end, right? I want to put 2 things together, and that's business retirement plans and retirement savings and small business. And in fact, in that word cloud that you showed, Rick, small business was on that word cloud. Small businesses represent 50% of the jobs in the United States. They represent 50% of GDP, and they represent 85% of the growth of our country. Small businesses are beset by what has come as a result of COVID-19. We know that the quality of one's ability to save for retirement is directly correlated to whether you have a retirement plan available to you through your job. And so having businesses having robust retirement plans, be they defined contribution, which is most of what the retirement planning vehicles are today, defined benefit is nearly gone. But having availability of that, the ability to easily do payroll deduction and to add my own funds to my retirement plan is directly correlated with the sturdiness of a retirement plan. So
Penny, let me ask you about
business to have those plans, and then getting people to participate in those plans is really important for retirement security in this country.
So let me just ask you about that. Whose job is it to make that happen? Because you can say, well, the employer should do it. But I mean, when you look at the stress that a lot of employers are under right now, I mean, we have thousands of businesses just going bust.
Right.
You could require businesses to offer this, but then you'd have to do it in some across the board way that did not raise costs for some set of businesses, but not for others. I mean, what is the right way to get more businesses to provide retirement plans for their workers?
Yeah, well, the folks believe that the challenge to employers doing that is all about the money part of it, the contributions that they would make to the plan. Often we find that it's just the complication, it's the lack of understanding about how to do it and where to go to get advice to do it. There are some policy some policy helpmates to that by giving tax credits to employers for the administrative costs of setting up a plan. That's one policy helpmate here. But it goes back to advice. It goes back to business owners and small businesses seeking out that kind of advice and help and getting these plans set up. Folks like Edward Jones and many other kinds of companies are there to help them do that.
Rick,
Roger?
if I could jump in here, a couple of points. One is, you said I would pick up on the first thing. In the current environment, I also think that it's important to continue a degree of what we call fiscal stimulus. As you pointed out, Congress passed and the administration signed several stimulus packages. The markets were expecting another one of those packages. That does seem to be at a stalemate now. But I would certainly say, continuing fiscal stimulus is a useful thing to do as we continue to see unemployment still very high, as we continue to see that personal incomes are declining a bit. And so, I would not skip over that one. When it comes to other things that can be done, let's recognize a few things that I think have already been the right thing to put into law, and we'll see how they play out. So one of the things that's occurred a year or so ago was the passage of something that I think the two of you know very well, but others may not, called the Secure Act. The Secure Act was very important, I believe, because it allowed for employers, those using the defined contribution route, to bring into those plans annuities, which turn those plans from being retirement savings plans to actual full retirement plans. So go from just accumulating to being able to do what we call decumulate, or pay out, a personal pension, so-called, during retirement. So the Secure Act, I think, helped solve one of the problems. Back to the issue that you've raised with respect to small business. One of the other things that is available now is what's called multiple employer plans, in which smaller businesses or smaller institutions of higher ed, for example, can band together and take advantage of creating larger scale to spread out some of those administrative costs. So that's a relatively new development that, at least in my company, we've seen has been helpful for the smaller higher ed institutions that we serve. And then there are a couple of other things I think we should talk about, which is taking advantage of the ability to do automatic enrollment and automatic escalation. These are, tools that leverage what we know about so-called behavioral economics, small nudges to get people to do the right thing. So I do think in the short term, in the crisis, more fiscal stimulus, and then going forward, some of the things that have already occurred have been helpful, and then a few other ideas as well.
Sometimes it's easier and more effective to if this requires government involvement to do these at a local level or even at a state level, where the politics are often just more pragmatic and less bitter and partisan than they are at the national level. Can some of these things you're describing, Roger, can these be done? Can city governments incentivize this or establish some regulatory framework for this happening? Can state governments do it? Is it happening anywhere?
Well, what's interesting is in fact, the kinds of things I've talked about around retirement security have proven to be actually bipartisan. So while there are many things are quite partisan, as you point out, there have been laws and bills suggested by Senator Rob Portman, a Republican, and Ben Cardin, a Democrat. And so I think there's actually a broader consensus across the aisles when it comes to retirement security than individuals might imagine. In part, I think, because of a point that Penny made, which is we recognize generally that the world of defined benefit is behind us. And so we have to accept and work with the defined contribution world and try to make that more like a defined benefit world. And that seems to be a place where there's bipartisan consensus because it's leveraging private sector behaviors, but leveraging also the best knowledge of what might happen or what has happened historically. So I would say let's not throw retirement security into that bucket of hot button partisan issues, because indeed what I've seen is the ability to work across the aisle, because this is something that everyone understands is a deep crisis, at least a challenge about to become a crisis, to use some of the things I said earlier. And so, I do think the federal government at this point has shown, some ability to move forward here in a way that may not be true in other places.
Let me ask you each about Social Security, if I can. Social Security is a treasured program, but it's not enough for most people to retire on. Joe Biden wants to raise the amount of income subject to a Social Security tax, which would provide more money for Social Security. He has also proposed, this is important to retirees too, lowering the Medicare eligibility range to from 65 to 60. Without asking either of you to endorse any candidate's position, does Social Security need more funding? And do these types of ideas, expanding the government social safety net for retirees, is this necessary? Penny, you want to go?
Social Security was never intended to be the significant dominant player in the average person's retirement, and in fact, we know a lot of these elements of the original Social Security plan. Social Security started at about the life expectancy of a person at that time. So Social Security was not intended to do what, in some people's minds, it's being asked to do today. I think this is one reason, Roger, your point is so well made, that retirement security provisions at the federal level are bipartisan in nature, because greater retirement security is important to take the pressure off of our safety net programs that have become the lion's share of our nation's spending. So that's it's a very real effect, but I don't think that it's going to be fruitful for us to count on Social Security as 100% of our nation's retirement planning.
Roger, we need more funding for Social Security.
Well, I would nuance it a little bit in the following sense. Social Security is one of the legs of the retirement security stool in America, right? It is also, interestingly enough, the one annuity that everyone has access to. People don't think of it that way, but indeed, it is actually exactly what it was meant to be. So Penny's right. At this stage, given the average amount that it pays, it should not be thought of as the primary saving vehicle or retirement vehicle for most people, but for some people it is, and it's part of the social safety net, retirement security net for almost everybody. So given that fact that it is so universal, I do think we need to understand how best to shore it up, so to speak. It's well understood. The trustees have told us that the trust fund, as it's called, is going to be depleted in 2033. I think the number is. It might have changed a little bit. And what that means is that without action, Social Security will only be able to pay out about 75% of what it pays today. And so I do think the question of how to deal with Social Security and make it a more secure part of the social safety net for elderly folks is going to be very much a topic. Now, there are just a range of thoughts and ideas that are out there. Some about sort of increasing retirement age, the age at which one can get full Social Security. Whenever that's mentioned, I know that my friends who have tough physical blue collar or pink collar jobs would say, wait a minute, delaying getting full Social Security means probably having to work longer than I possibly can. Those of us with white collar jobs can imagine, delaying taking full Social Security, till the age of 70 or something of that sort. There are also some technical fixes that people often talk about. As you know, Social Security rises with inflation, which is, in theory, a very, very good thing, so that folks living on Social Security don't have their income gradually eroded by inflation. But there are technical questions about how do you measure the right inflation index. I'm not going to get too geeky on that one, but it's a very important topic. And then the kinds of topics that have come up around those who earn more and can afford to contribute more. Is that the right thing to do? So I do think there needs to be a serious policy discussion, recognizing that the trust fund is going to be depleted in the nearer than planned future, and recognizing that while Penny's right, it's not the only source of retirement for many people. For some, it is, and for everyone, it is part of the retirement safety net. So I do think some serious debate and attention and finding bipartisan path forward would be a welcome idea.
Roger, you mentioned that Social Security Trust Fund. I think it's just to mention it, the Medicare Trust Fund is in worse shape than the Social Security Trust Fund. I think the latest official report says the part of the Medicare Trust Fund is going to start running short of money in 2024, but that was before the COVID recession. And now it could be running short of money as soon as 2022 or 23. This will be a job the next president is going to have to deal with for sure. I think we have the second set of poll results. So let's see if we can pull those up, and I'll remind people what the question was. I can't tell. Okay, the top one, it's in really tiny print, so excuse me. The question is, which policy shift would be most critical to narrowing the retirement gap? And it looks like the top answer was the second one, which is create incentives to increase individual retirement account contributions. And then the number 2 answer was bolster and enhance Social Security. Maybe you can all see that better than I can. But again, it looks like the number 1 answer, create incentives for people that voluntarily make contributions to their retirement accounts. And the number 2, it looks like 28% of you said bolster and enhance Social Security. Roger, Penny, either of you have a response to that?
I'll go first on that and say I'm, in some sense, not at all surprised, right? It's a reflection, the fact that the number 1 answer was basically increased private savings is a reflection of 2 things. One, I've talked about earlier in one of my first answers, which is that there is a savings gap, call it 4 to 7 trillion. I've seen those sorts of estimates. Secondly, it's really a reflection that there has been a shift of retirement risk as Professor Hacker at Yale has said, from defined benefit plans to defined contribution plans. Penny mentioned that as well, and that does mean that savings, private savings, becomes much more important. And so I'm not surprised that that one sort of popped to the top. Social Security, for reasons we've talked about, I think would always play in because there's so much headline discussion of Social Security. I guess those two answers being the top two, I think reinforce some of the commentary and conversation we've been having thus far.
Just want to remind everybody, we are happy to take some questions from the audience. The way to submit questions, I am told, is go to the box on the right of your screen that allows you to submit questions and leave a question for our panelists there. Let me ask each of you, what are the sort of top mistakes people make in terms of planning for retirement? And are they making the same mistakes in the age of COVID, or are they now making different mistakes? Penny, you want to answer that first?
Sure. I think I'll answer by saying it's the same as it ever was, but more acute. The mistakes made in saving for retirement have to do with not thinking long-term enough and making emotional decisions in the moment. Not thinking long-term enough, I'm going to take it from an optimistic perspective to say there's never too little to start with. It's never too early to start. And by having that long-term orientation and being planful, to use that word that I used earlier,
yes,
one can, because of the miracle of compounding, the miracle of taking personal responsibility for one's resources and thinking about a future of your desire, one can create good options for you and your family. Good advice is very often a part of that. The second aspect that is the same as it ever was is making emotional decisions. When the market got really turbulent in February and March, we saw exactly what we always see, which is equity outflows and money going to cash and gold and things like that. Those are emotional decisions in the moment that can have very long-lasting effects on one's goals. And so it's those balancing one's emotions. The one that we're about to, that we're already in the midst of is the election cycle. We say, do not play politics with your portfolio. Keep your emotions out of how you're managing your money during times when markets can be volatile.
Roger?
So let me agree with what Penny has said in many ways and then reinforce a couple of points. So I think she's absolutely right to say that people often make a mistake of thinking that they should delay their savings for retirement until they can save more. And I think she's right. Never too early to start and never too small amount to start as your contribution to get into the habit of saving for retirement. I fully agree with her as well on not letting emotions drive behaviors. The data tend to show that retail investors, unfortunately, often get out at the bottom of the market. They've watched the market go down, and then they get out at the bottom, and then they often don't get back in and miss the rally. So staying in markets is important. Two other things I'd add. One is diversification. And so thinking about equities, bonds, even real estate, if you have access to that as an investment option. So a broadly diversified portfolio, I'd add to the other points that Penny made. The final one I'd add is one that you asked the question, what is the biggest mistake that people make? And I think the biggest mistake that people make, and it's tied to Penny's point, is they may often underestimate how long they're likely to be in retirement. Retirements of 20 or 30 years are not uncommon now. And what we see in America, at least, is that people tend to underinvest in the one financial tool that can give them a private pension, so to speak, or a retirement paycheck. And that's something called an annuity. It's very interesting when you ask people, do they want a retirement paycheck, a private pension? The answer is almost always yes. when you say, do you want an annuity, the answer is often no. Economists describe that as a problem of framing. So I think the biggest mistake that people make, they delay savings, they don't save enough, we know that. Many of them don't even sign up for their plan at work. But I think the largest mistake is underutilizing a tool that can give them a retirement paycheck. And that is, I think, in part because they underestimate what's called longevity risk. Penny talked about the fact that people are living longer. I've mentioned that, and that's called longevity risk. So using a financial tool to have an insurance company take your longevity risk as opposed to the individual taking it is, I think, a mistake that is certainly recognized here.
Longevity risk is basically underestimating how long you're going to live, right?
It absolutely is underestimating how long you're going to live, and consequently, perhaps underestimating the risk that you're going to outlive your savings. People get very focused in on, the size of what they've accumulated in terms of saving for retirement, but don't really tend to think very much about, now, how am I going to, it's called decumulate, how am I going to sort of draw that down during the phase of retirement? And some of the, the rules of thumb that people talk about may or may not work for everybody. And so it goes back to a point that Penny and I both agree on, which is the need to have, solid advice, but also to recognize that there are a range of financial tools that can help offset some of the risks. And it's interesting because, people certainly buy life insurance. That's for, what happens if you have an unfortunately short lifespan. They don't buy as much longevity risk insurance as they probably should. Call that an annuity, which is what happens if you have a surprisingly and pleasantly longer than thought lifespan. And so, these are serious issues to contend with.
Let me ask you both about the age-old 60-40 rule. As you approach retirement, 60% of your investments in stocks and 40% in bonds. I just looked at the 10-year Treasury. It's yielding 0.73% today. Everybody knows you get hardly any return on simple fixed income investments anymore. Is the 60-40 rule dead? And if it is, what is the new 60-40 rule?
Well, Roger, you opened this conversation up just a couple of minutes ago. It was such a good point about diversification and the importance of diversification. And it would be very dangerous to say that the tenets of diversification are dead because of the low interest rate environment. That is the wrong way to look at this. 60-40 has always been sort of a cliched kind of rule of thumb. It really is dependent on one's appetite for risk, one's risk of longevity, as Roger so well put it. The right proportion of equities and fixed income or interest-paying investments is a very personal thing. However, that rule of thumb associated with diversification, meaning don't put all of your eggs in one basket, it's still very, very important. Another mistake that investors will make is looking at the returns of the stock market and saying, well, I'm not getting all of those returns. There must be something wrong with my investments or my portfolio. No, indeed, if you are getting all of those returns that the market is returning right now, you are taking too much risk, because when the market goes wobbly, you need a ballast against that wobbly behavior in the stock market. And that's what bonds, cash are all about, is providing that kind of ballast. You may not get all of the upside, but you're also not going to get all of the downside. And it is very tempting right now, with bond rates as low as they are, to throw out this age-old, well-proven wisdom of diversification. And that is that's a common error as well, saying this time it's different. I've got a better idea than diversifying my portfolio.
Roger, let me tweak the question for you. So we are talking about this on Yahoo Finance literally every day. Isn't the Federal Reserve putting a floor under stocks and making stocks safer than they might otherwise be?
Well, certainly by reducing interest rates, we know that the Federal Reserve has supported, asset prices, across the board. So not just stocks, but houses as well and other assets. Absolutely true. They're doing that in order to also put a floor under the economy so that the downdraft that we've had is a recession and not a depression. And so I think it's the right policy decision. Having said that, I think Penny is also right. All equity, all asset classes have cycles, ups and downs, and we know full well that sometimes retail investors misuse or misunderstand the cycles. They try to time markets when they probably shouldn't. So it goes back to, I think, a point that both Penny and I have made, which is diversification is very important. Even with interest rates very low, one should not look at the equity markets as a riskless investment, because we also see that there is volatility in those markets as well. And so, I agree with her on the notion of diversification. The other point I'd make is you started with, well, gee, is the old 60-40 dead? I think the reality is 60-40 was something that everyone had to look at through his or her own risk lens. For some people, 60-40 may have reflected exactly their risk appetite, their expectations for longevity based on what they know of their own health. For others, that may never have been the right rule. And so I think this question of how you take advantage of diversification across real estate, across equity, across bonds, to some degree across cash, obviously, is very much a question of your own risk appetite and the ability to sort of execute a plan. That also, the other point I'd make about all of this is, retirement shouldn't be set it and forget it. We do encourage people to do a rebalancing. Take a look at your portfolio. We often say on your birthday, to see if the ups and downs of markets have left your portfolio at the end of a period on your birthday, let's say, reflective of your risk tolerance. And so, some things that have been very, very good, it might be time to lighten up a little bit if you think about it over the cycle. And so even if 60-40 was ever the right thing, and for some people it probably was, for some people probably not, thinking about that in your own risk context is important. But then thinking about how you want to rebalance back to whatever you think is right for you is important. So this notion of diversification and rebalancing, I'd add to the conversation that we've had.
We've talked about people underestimating how long they're going to live. In other words, life expectancies have gone up and people need to prepare for a longer retirement horizon than they might think they do. Do either of you advise clients to maybe take a little more risk for a little longer as they approach retirement age?
Well, it's a very personal assessment, as Roger well said. I think one thing that I'll bring up in answering that question, Rick, is that there's another phenomenon that's very interesting during times of extreme market volatility or extreme circumstances in the economy. It changes the generalized level of risk appetite that investors have. And so the one that's commonly referenced is folks who were growing up during the Great Depression had a very different point of view about the way they spent, invested, or borrowed. And the same thing happened during the Great Recession. Risk appetites were reset, and there's a chance that that's happening today. And so what occurs sometimes is that folks who are younger, who are growing in their understanding of the risk and investment markets, are affected by these exogenous variables that actually in their youth leave them far less interested in risk than they should be, because of the fact that they have a long time horizon, they've got a long life to live. They actually ought to be investing more heavily in those risk-on assets, those risk assets like the stock market, than they are comfortable doing because of the very emotional effects that have occurred as a result of what's going on in the environment.
Roger, real quick on that one, then I want to get to an audience question.
So I think the role of equities in retirement is something that as Penny said, one does depend on personal preferences and risk tolerance. Point two, though, I do think even as one approaches retirement, having the right amount of equity exposure is very important. And the reason is that we know that over longer periods of time, while there's volatility, the probability of equity returns, I think the S&P has yielded roughly 7 or 8% over long periods of time, is tends to be somewhat higher than bonds. But the other point I'd make is there's another way to think about how the equity portfolio works for an individual versus their fixed income portfolio. And the equity portfolio can be, as I just said, a bit of an inflation hedge. You might also think about your equity portfolio as where you go for those discretionary expenditures. So if you want to have a bit of money when things are good, equity markets have been good, and you can use that for a more exotic vacation. When equity markets haven't been so good, maybe you have more of a staycation. And so I think diversification, maintaining a reasonable chunk of equity, even as one is getting closer to and indeed into retirement, is important. But thinking about how you use the cash flow or the capital gains in equity as playing a different role from what you might do for other parts of your portfolio. The final point I'd make is back to a point I made earlier. I've talked about annuitization. There are two types of annuities. There's a fixed annuity, which again will give you a sort of a paycheck that's relatively predictable. But then there's also the variable annuity. And for those who want to get some exposure to the equity markets, a variable annuity might be a way to do that. And again, as I've indicated, use the return of the variable annuity for discretionary expenditures. Use the returns from the fixed annuity for your more predictable day-to-day expenditures. So long answer, absolutely keep equities in the portfolio. Think about how you're going to use them and recognize that it depends, again, on your risk tolerance.
Guys, we're running short of time. I'm going to do kind of a lightning round here with at least one audience question. The question is, can you expand on gender issues in retirement security? But let me just kind of focus that question in this way. First to you, Penny. What can women do to be better investors? Short answer.
Understand what's most important to you, what you're trying to achieve long term. Get some good advice, be educated, and put in place a plan and stick with it.
Roger, let me put that to you and say, whatever gender distinction you think is most important, you can answer either men or women. What is the one thing either women or men can do to invest better?
Well, with respect to women, two things. One is, Penny put her finger on it, which is women actually tend to be, the data show, pretty good investors, partially because they have a broader sense of how to balance risks and reward. Women also should recognize that they have a slightly longer life expectancy than men, and often they will be inheriting estates from their husbands, from their spouses. And so that issue of longevity risk, I think, becomes perhaps even more important for women to focus in on. With respect to men, the flip side may well be true, which is the data, I think Penny will confirm this, tend to show that men perhaps have a high degree of confidence in their own judgments. Want to be careful about making broad generalizations across the genders. And so maybe being a little more aware of the risk-reward trade-off and avoiding an over degree of confidence might be important in that case.
I think you can comfortably generalize that men tend to be overconfident. I'll take that one. Penny, let me give the last one to you. The question is, can you talk more about how pre-retirees can strategize for both retirement savings and anticipated health care and long-term costs? Let me just try to focus that real simply because we're down to just about a minute. We've now had two financial crises, major recessions within 10 or 11 years. Let's assume you just have to assume these things are going to happen. How do you prepare for that as you are saving for retirement? You're looking ahead and saying, look, I know there's probably going to be some major bump in the road. What do you do to get ready for that?
Yeah. Prepare yourself for that longevity risk, for taking the emotion out of investing. And to the questioner's point, recognize that healthcare costs are probably going to be significantly more than you think that they are. And so they have to be factored into your retirement planning. There's another element to that. do your level best to stay very healthy physically, take good care of yourself, wash your hands, so that your retirement funds can go longer for you.
All right. It's been a terrific discussion, tons of useful information. Thank you both again. Roger Ferguson, President and CEO of TIAA, and Penny Pennington, a managing partner at Edward Jones. Thank you both, and thank you all for tuning in.
Thank you.
Thank you.